G'day everyone, welcome to this update on global markets, and we had a couple of nasty sessions down in the US, particularly on Friday night. Now there are some particular circumstances around that decline that I really want to dig into in detail, but my view at the moment is that this is a market overreaction, and I want to explain why that is the case. So the big picture that I really want to explore is that this is really a correction that we had to have. We haven't had a 10% correction in the market for quite a long period of time. So this is actually healthy. Now, I've talked about this many times. There are 3 or 4 fundamental precursors that you need to establish a major market top and turning point. And they relate to the amount of money that's invested in the market, that relate to the extreme positive sentiment. It relates to interest rates, and these things are just not in sight. So it would be the first time in history that we've got a major market top when none of the fundamental precursors for a change in economic direction are present. So I'm not saying it can't happen, but it would be the first time in history that it has. Secondly, technically, there will almost certainly be a rebound. Even if this is a significant market top, there will be a rebound to at least a lower peak, and human psychology virtually demands it. And that's the aspect that I want to explore first of all. So before we look at the S&P in recent times, I actually want to take you back to the period from 2003 leading to the 2007 top, and then of course the major bear market that came from that during the GFC. Now I've done this before, but I think it's really worth reiterating at this time. So back here in 2003, when the market bottomed out after a couple of years of going down, we started an uptrend, and you'll notice that the red moving average line, the 150-day moving average, went into a fairly steep uptrend. The price of the index was above that uptrend almost the whole time. We got a few flat bits where the index value went below the moving average for a period of a handful of weeks. The moving average flattened out a bit, but it didn't ever really roll over. So you can see all the way through here, we had a couple of little instances where the index was briefly below that red moving average line for a very short period of time. But basically it was above it, and the moving average was rising, and we didn't get any really severe pullbacks during that period. Even here was really pretty mild, and the moving average really only just turned over into a bit of a flat period. That was August 2006. So we got to move all the way through to July of 2007, which is 12 months before the major part of the bull market, the bear market came into being. So this is a year in advance. Now we got a sudden plunge in the index. That was the first warning sign that the character of the market was changing. But you'll notice that the market then fairly quickly, so this significant fall occurred from the start of August through to about the 17th of August. So it was pretty much the same time period that we're in right now, and it's traditionally a weaker time of year. So we got a sudden plunge, but then the market roared back up again and formed a new high by October. Now, human psychology demands that almost, because there's so many people out there that are thinking that this is just a correction in an ongoing bull market, and so they buy back in. So whatever happens this time round, we're almost certainly going to see a sharp rebound of some dimension. But you'll notice at this stage that the moving average is still rising. Got a little bit of a flat spot in it there, but still rising. We then got another plunge. So we formed a slight new high in October of 2007, but then the market went down sharply again. Now that was the warning that once again we were quickly underneath the moving average. We rallied back to it, were unable to sustain anything above it. The moving average has just started to roll over, and then down the index goes. So that was really the confirmation there, the failure to get back above the moving average, and the moving average rolls over. So we're talking December 2007. This is 7 or 8 months before the main part of the GFC. So clearly a change in character. And then of course we went into that major plunge during the GFC. The moving average had rolled over completely, and then the cycle goes through its normal part again. Now move forward into this current rise, and you can see we certainly had some volatile bits. It wasn't a straight sailing coming out of the GFC. We had a bit of a nasty period in 2010, but you'll notice that the moving average only went sideways, and the index was only below it from the end of May to basically the end of August. We then got another rise. We then got another fall in August of 2011, but it was only temporary. But you'll notice throughout this period, at a big picture level, and particularly the last 3 years, see how the moving average is still heading up. The price of the index, we had a brief excursion below it in October of last year, but then it quickly regained, formed a new high, didn't fall away as it did in 2007, kept rising, and we've now got through to this period we're in right now. So let me tighten up on that. So we've had this lengthy consolidation period, and now we've had this sudden plunge in the last 2 days. Now, look, it doesn't look good. It was an ugly couple of days, but I would have to say that Friday night was options expiry in America, and monthly options expiry, and you quite often get some really weird price movements around that period. And there's another aspect that I'll point to in just a minute. So at this point in time, the moving average is not rolled over. The price has been underneath it for a couple of days, and we haven't really had the wild volatility swings that are typical of a major market top. Now, we may end up getting them, but before we get to that point, there'll almost certainly be a rebound. So my strong message to you is, if you've got exposure in the market that you want to get out of, then wait for the rebound, because it's almost inevitable. But personally, my view still is that we are not at a major market top. This is just a correction in an ongoing uptrend. There's still too much good value in America for a major top, in my view. So let's look at some of the other detail then. The other point that's worth noting too is that some sectors can actually rise during a significant index decline. If you look back in history, so it's not a matter of every stock gets absolutely belted. It's just not the case at all. So the S&P, was not up by 14 points on the week. That's obviously in error. I didn't amend that from the previous week. It really was a horror week. We'll figure out what the actual point decline was in just a minute. But look, it was overdue. The market has gone up too long without a 10% correction. We talked about that last week. As I mentioned, options expiry, it's, I think, more than coincidental that it was options expiry on Friday night, and we saw declines in a lot of the big stocks, the ones that have options around them, and we saw a lot less selling in some of the smaller stocks, and we'll see that when we look at some of the other indices. So this was sheer panic selling for me, but now there are bargains, and I think that's the key point. So the S&P was down 8% from the peak, but at this stage I see it as just a healthy correction, one that's a bit scary, admittedly, but just a healthy correction. So the next support is around 1940 and then down at 1822. So let's look at those couple of levels. So 1940 is the third Fibonacci retracement level from the peak down to the October last year lows. So that is likely to provide us with a bit of support, not much further down. And then, of course, if that gave way, then we could look at retesting the October low from last year. At this stage, I don't think that's likely, looking at the fundamentals and looking at the value, but it's possible. Now, if we look at the NASDAQ was off sharply as well, just as sharply, and there was heavy selling in stocks like Apple, for instance. But these are stocks where the options market would have a lot of activity. Let's look at the Russell 2000. This is the small caps. not down nearly as much. And look, that didn't close on its lows. Actually closed a bit off its lows. So that to me says that there was nowhere near the selling in the small caps as there was in the large caps. And that, I think, again, it's not coincidental that that's related to options expiry. So I'm not panicking at all at this stage. I'm seeing this as an opportunity to to pick up some bargains, but not yet. So the Aussie stocks, the Australian dollar remains in strong downtrend. Short term, we're consolidating a base, and particularly as the expectation for September rate rise in the US fades away a bit. But I think the trend for the Australian dollar is still down. Now the Aussie index lost 140 points for the week, so it was a poor week. But Monday's going to be a shocker, following on from what happened in America. And I would have to say that the earnings season in Australia has been pretty lackluster so far. So if we look at the ASX 200 index, I've talked about this week by week as it's unfolded. We've got this downtrending channel. We had a minor breakout from that channel, turned out to be a false break, and we're down back into the channel. And the Australian futures finished about 5,050, so we're going to be way down here off the chart on Monday, no question about that. Turning now to commodities, gold was up by another $46, so we've seen two back-to-back rises in gold. So we're finally seeing a safe haven reaction to what's going on around the world. And by the way, just on China, I mean, everyone is absolutely stressing out about China. And yeah, they've got some speed bumps, certainly, but you can't transition an economy from being heavily infrastructure focused and heavily export driven to one of consumption and the growth of internal services without a few speed bumps. And I think that's all that's happening in China at the moment. And the one thing that's not being reported in China is the really good economic growth surrounding internal consumption and the growth of services in China. So, there's a lot of positives in China that just aren't getting reported. So I'm not a China bear at all. Now, so gold was up 46, but the gold stock indices responded, but it wasn't all that convincing. So I'm not convinced that this run in gold has got any legs yet. We'll have a look at that in a minute. Copper was down a little bit to 228, finding a little bit of support. Crude oil fell apart again, down to $40. Remember, it was up in the 60s not that long ago, and I said it would have to roll over. The supply and demand would demand that it would roll over, and this has been very sharp. The International Energy Agency says this supply glut is going to continue until 2016. Let's just look at the price of gold. This is the weekly chart. So you can see we've bounced off that long-term uptrend line fairly nicely. So we broke down from a lengthy consolidation period, hit that support. We've had a little bit of a bounce. That's pretty normal. I wouldn't be surprised if we see this fall away again. Let's look at the gold stock indices because they tend to lead. And you can see not as much of a rise, and we certainly had some selling, despite the fact that gold went up on Friday night. We had some selling in gold stocks, but again, quite possibly just the major gold stocks being sold as a consequence of options expiry. There's the spot copper chart, so still in a fairly strong decline. So just to wrap it all up, the strategic approach, this has been coming for a while, this correction. So you should be well positioned. I've been talking about this now for about 3 or 4 months. Anyone who's been caught out with too much exposure just really hasn't been listening. There are great bargains out there now. I'm actually finding it's a pretty exciting period, but I would err on the side of caution until this is actually what I wrote last week. Err on the side of caution until we see a spike down. Well, we've seen that in the last 2 days. Or we move into October. So that's what I wrote last week. Now, my sentiment remains the same, but the falls of Thursday and Friday are so sharp. You think about the psychology of the market, there'll probably be a little bit more selling yet. So I am expecting a bit more downside, but it could bounce around a bit first. So I think stocks could get a bit cheaper yet. So I wouldn't be doing anything just yet, but we're certainly down into the territory now where the sectors that I do most of my playing in are looking incredibly attractive. Some great bargains. So that's it. Bit of a lengthy one this weekend, but look, I thought it was important to go through that big picture, because at this time of year, your success in the market is a heck of a lot about how you manage your emotions as well as about how you manage your actions. So I thought it was important to put that all into perspective. There's if you want more details on what I do and how I may be able to assist you, it's my website address and my email address if you want to contact me. That's it for this week. It'll be a pretty bumpy week next week, I would expect. But yeah, looking forward to how it unfolds. That's it for this week. Cheers.